Hello again and welcome to Money Matters. Hong Kong's Fintech Week went off with a bang as the government announced regulations that would make Hong Kong an international crypto hub. A week later, FTX, the second largest crypto exchange in the world, declared bankruptcy. Tonight, we take a look at the buzz during Fintech Week and how the FTX collapse might impact virtual assets. The summit was abuzz with news of Hong Kong regulations, which will give retail investors access to virtual assets like cryptocurrencies, as well as the tokenization of green bonds and the development of ETFs for virtual assets, among other things.
But having this statement showing the government commitment, showing a very clear path of our regulatory direction would definitely induce confidence to them for further investment in Hong Kong for virtual asset or the fintech business by and large.
I think today's announcement is a really positive step. It demonstrates that, not just that Hong Kong can and wants to have a leadership position.
Hong Kong is one of the very few jurisdictions globally now has an overarching virtual asset regulation framework that covers both security token as well as non-security utility token. That's going to be a very significant advantage for Hong Kong going forward as a, virtual asset financial center.
All great news, but just a week later, Sam Bankman-Fried, founder of exchange FTX and Alameda Research, filed for bankruptcy, declaring an estimated 10 to 50 billion US in assets and liabilities and more than 100,000 creditors. 1.2 million FTX customers will likely lose their crypto savings, and firms tied to his companies are already declaring write-offs.
It shines the light on the fact that operators holding client assets, it doesn't matter if it's traditional finance or digital assets, the amount of hurt that can be done to the consumer is the same in both cases. Any firm holding client assets should have fit and proper controls to protect the consumer, regardless of asset class. Organizations holding client money need controls. There's consumer protection, bankruptcy remoteness, there's fit and proper, assessments of the individuals in the organization.
Hugh Madden, co-founder of OSL, the only crypto exchange licensed to operate in Hong Kong, says that while this regulation is good, enforcement hasn't been. And retail investors who want to trade in crypto but can't access regulated exchanges are pushed offshore where they have no protection.
There's been no enforcement. So foreign players are still, in some cases legally and lawfully, operating on a completely unregulated basis, taking client monies. There's a risk that enforcement continues to be missing. And players continue to operate with impunity. The protections the SFC framework has is exactly what retail needs. Bankruptcy remoteness, client asset segregation insurance, controls to make sure that their funds are kept safely. And yet in Hong Kong, the framework is institutional and professional only.
He adds that Hong Kong's new regulation should not grandfather unlicensed operators in the city, allowing them to operate for a few months or years while they wait to get their license. While virtual assets was one of Fintech Week's headline topics, so were Web3, the metaverse, and payments via digital wallets, the latter of which is set to grow even more as smartphone penetration has already hit 83% globally.
Digital wallets really serve the underbanked population. You don't need to have a credit card or a debit card in order to use a digital wallet, hence its popularity in places like India, in Vietnam and Indonesia, where it is the leading payment method. For them, accepting digital payments such as digital wallets is also very convenient. Often it can be consumed by just availing a QR code. Merchants no longer kind of have to go down the traditional route of getting a terminal that they have to rent from a bank on an ongoing basis. And more often than not, the cost of acceptance is also a little bit cheaper than processing traditional credit and debit cards.
Yvonne Cito of FIS WorldPay, one of the largest global payment companies, says that embedded finance is another growing trend. These are financial offerings via apps such as travel insurance when purchasing tickets or buy now, pay later options when shopping.
Underpinning that is really the partnership between financial institutions and non-financial institutions and big tech coming together to provide technology that essentially allows a consumer to be offered a financial solution at every interaction at the right time.
The metaverse, a place that many Gen Xers and older aren't that keen on hanging out in, was a hot topic at the show.
Oh my God, okay, I think I'm done. This is exhausting. I think I'd rather play in real life.
For young people around the world, the metaverse and digital is the medium of choice. They already are spending most of their time online. You know, their digital avatars, their digital life, their digital society is more valuable and more important than their physical one. But they don't own any of that. It's currently owned by Facebook or by Amazon or by Apple.
Yatsu, CEO of Animoca and investor in Sandbox and a number of companies already in the metaverse, says that the combination of Web3 and the metaverse will allow ownership to go to platform users rather than the social media giants people currently use.
Where the relationship changes. For instance, if you buy land or own land in Sandbox, you're not just a customer consumer, you're a customer owner. You have a part in the ecosystem of the world that is Sandbox. So for instance, if I own a Bored Ape, I can license it to third parties and create t-shirts or basically have a fashion line. If I own land on Sandbox, I can hire or rent it out to someone or have someone else basically build an experience on top of it without actually needing to seek permission from the platform itself.
With Web3 and the metaverse ultimately operating on blockchain technology, the same technology underpinning cryptocurrencies, virtual assets were of course in every conversation, including the development of central bank digital currencies or CBDCs and potential regulation of stablecoins.
At the moment, if you want to come to our exchange and you want to invest in a certain project, it's not as easy. If we can do it going forward using CBDC, much easier. And obviously stablecoin, I think, has become a very massive asset class now. It's one that you can't ignore, and I think you do have, although there are a number of different stablecoins on the market, but they're all actually very different animals. And the risk and reward of those coins is not well understood. So I think more transparency needs to be put into the process.
Financial Services and Treasury Undersecretary Joseph Chan says the government has an ongoing study into the e-Hong Kong dollar, as well as a consultation paper on stablecoins, but is prudent on how they will be handling it. He adds that investor education is one of the key pillars his office is taking up.
We have been working through IFEC, Investors and Financial Education Council, and SFC in terms of stepping up our effort in public education on virtual assets for the public. And in fact, we have formed an advisory committee under IFEC that I myself is the chairman of the advisory committee, so that we can steer in terms of the work under IFEC to ensure important issues such as a virtual asset would be well covered in terms of our public education effort.
In the meantime, Hugh has a word of warning for investors.
What will disappear in an awful hurry is all of these so-called yielding products where it's not clear where the yield is coming from. I think those high yield for no good reason products, they're gone. Literally overnight, within a week or two, there won't be any more.
Hopefully, the government's new licensing will come out in time to protect investors, and enforcement of current regulations will be more aggressive.
From the government's perspective, right, we think that virtual assets are here to stay. Virtual assets are here to stay. And it opens up a lot of opportunities with Web 3.0 and Metaverse. So from a government level, we want to embrace the opportunities, but also in a regulated manner to protect investors' interests and also address certain risks, be that money laundering risks and other type of financial risks as well.
Chinese consumer spending contracted in October and factory activity weakened as antivirus controls weighed on the economy. Retail sales sank 0.5% compared to a year ago, down from September's 2.5% as millions of consumers were confined to their homes. Growth in factory output decelerated to 5% from the previous month's 6.3%. The performance was weaker than expected by forecasters, with some expecting November may be worse. Financial Secretary Paul Chan said the government expected to see a fiscal deficit of more than $100 billion this year. But he stressed that authorities had sufficient reserves to cope with the city's weakening economy. Government earlier downgraded its GDP forecast for the year, estimating the local economy to shrink by 3.2%. The finance chief noted the local economy would be affected by factors such as poor global market conditions and rising interest rates. However, he said there was no need to be too pessimistic. Chan added that more relief measures may be rolled out next year, depending on the city's economic situation. China has issued sweeping directives to rescue its property sector, the strongest sign yet that President Xi Jinping is turning his attention toward shoring up the world's second-largest economy. Regulators issued a 16-point plan to boost the real estate market, with measures that range from addressing developers' debt problems to loosening down payment requirements for home buyers. The initiative comes at the same time as a push to reduce the economic and social impact of COVID containment policies. The major policy shifts by Beijing will likely support the growth outlook. Chinese developer stocks and bonds soared, and a Bloomberg intelligence gauge of mainland builders surged as much as 15%.
Up next, how consumers and businesses have reacted to global inflation and a high dollar. Stay with us. Welcome back to Money Matters. In nearly every corner of the world, people are feeling the impact of inflation as the cost of living continues to rise. The higher U.S. dollar is also causing a cost squeeze in countries where the local currency can't keep up. And inflation isn't impacting people equally. Families on lower incomes around the world are feeling the squeeze much worse.
Ali came to Dubai in the United Arab Emirates in February, after several years searching for work in his native Egypt. Nothing he found provided a living wage, but it was a gamble he was willing to take.
In Egypt, life is expensive and wages are low. They don't cover enough, so I took the step of leaving. I had friends who told me to try and come here and work. I liked the idea and thought I'd try it out. Anyway, living is expensive in Egypt, so there's no difference.
Ali is from a province in the Nile Delta and supports a family back home with his dwindling buying power in Dubai. A staggering 71 million more people around the world have experienced poverty as a result of higher food and energy prices that came in the wake of COVID bottlenecks and Russia's invasion of Ukraine. Restaurant manager Mohammed Yunus says he's constantly being contacted by Egyptian men looking for work and a way out of Egypt, where prices have risen 16%. He warns that making the move to the UAE comes with risks because finding a job takes both time and money.
I have a lot of staff whose families rely on the income they make from the restaurants, and a big portion of their incomes are sent back home so people there can live.
And yet, he says the number of young Egyptian job seekers hasn't stopped rising.
We are an Egyptian restaurant, so I get a lot of Egyptian people coming to me. Lately, the number of Egyptians who are looking for a job and who come and ask me for a job has increased a lot. Some send me messages and some speak to me in person.
The ripple effect of the Ukraine war on grain importing countries made worse the already dire economic conditions in countries still reeling from the economic shocks of the COVID-19 pandemic. The International Monetary Fund estimates that global inflation will peak at 9.5% this year. But in developing countries, inflation is much higher. The UN says families in low-income countries spend over 40% of their household incomes on food, despite government subsidies, and says 500,000 children are at risk of death due to malnutrition or famine. Those that manage to make a little hard currency can transform life back home. Some settled immigrants in America are borrowing money to send home to the family.
If you send someone $100 back home, that's a lot of money. I mean, they can make a living out of it. But after the inflation, they have to have at least $120 to just buy basic necessities. So even though the living standard is still much, much cheaper than the United States, still the inflation back home is making it difficult for everybody because they have to everything. Some of the items they told me is double.
Osama says he feels pressured to help his family in Somalia, but inflation is also higher in the U.S.
I have to be more mindful the fact that I have to help my relatives back home. It also affected me in a way. I have to watch my expenses. I have to be careful about how much money I spend per month.
The rising U.S. dollar continues to keep other countries on the back foot. Low-income developing economies have found doing business in the strong dollar, higher interest rate era difficult. In a gritty neighborhood in Nairobi known for fixing cars and selling auto parts, businesses are struggling. With the Kenyan shilling down 6% this year, the cost of fuel and imported spare parts is soaring. So much that some people are choosing to ditch their cars and take public transportation.
Sometimes you find that there is an increase of about 10 to 20% in the cost of a spare part within a period of maybe 6 to 12 months, which people are not expecting. For us, like now we're in wholesale and retail of parts, and you find that most of the customers are complaining a lot.
With business dropping and less money coming in, Albert Chega, another auto parts dealer, says his family's quality of life has suffered.
We are continuing to lose. If I used to take my children to holidays, they cannot enjoy those holidays anymore because of the weakening shilling. We don't have enough cash flows to play about in the house.
Around the world, businesses are sharing the pain and frustration. From a seller of baby clothes and bags in Turkey to a dry food trader in India, they all have the same complaint. A surging U.S. dollar makes their local currencies weaker, contributing to skyrocketing prices for everyday goods and services.
People buy goods, they sell goods, but there is a difference in time between them. If during that time the currency changes, the manufacturer or the buyer can lose money. And all this, remember, is also tied to inflation. And not just inflation, but expectations of inflation. So if I'm selling burgers, how much should I price them now? Or should I keep changing the price every day?
According to the benchmark ICE Dollar Index, the greenback is up 18% this year against a basket of key currencies. The reasons for the dollar's rise are no mystery. To combat U.S. inflation running at its fastest rate in 40 years, the Federal Reserve has raised its benchmark short-term interest rate 5 times this year, with more to come. In New Delhi, many small businesses have thrived for decades, working as brokers trading almonds and pistachios. But a record drop in the rupee, on top of higher raw material and shipping costs, have driven importers nuts.
Our landed costs have gone very high, and with landed costs getting high, it'll be more costlier for the end consumers. The products will become more costlier, and higher the cost, it'll lead into demand destruction. Ultimately, if the consumer is not buying, the entire supply chain gets impacted, and the supply chain includes people like us, the importers, the wholesalers, processors, and everybody.
The soaring dollar in 2022 is uniquely painful for many developing economies, as the rise has added to already strong global inflationary pressures at a time when prices were already rising after the pandemic. New Zealand scientists are working on ways to prevent cows and other farm animals from burping too much in a bid to reduce harmful climate change. The country is planning to reduce methane emissions by up to 47% by 2050, a significant target as nearly half the country's greenhouse gases are produced on its farms. How do you stop cows from belching? It might sound like the start of a joke, but this is a serious matter for climate change scientists in New Zealand. First step is to reduce the methane in each eructation of every cow. Every gusher a cow lets loose contains methane, a greenhouse gas 25 times more potent than carbon dioxide, CO2. One solution may be to tinker with the cow's diet. In one government greenhouse, scientists are developing genetically modified ryegrass and white clover that the animals predominantly eat. A team of scientists discovered increasing the tannins in the grasses would block the production of methane in the digestive system by up to 20%.
Actually, they identified through their research a master switch that switches on condensed tannins in the leaves. So through genetic transformation, they've been able to put this master switch into white clover, and after rounds of conventional breeding, been able to elevate the levels of condensed tannins in the leaves.
Another approach is to use vaccines that have the potential to reduce the amount of methane spewed by 30% or more. The various programs are moving slowly but surely to cut the burps in all of New Zealand's 26 million sheep and 10 million cattle.
That's the show. Thanks for watching. Next time on Money Matters, how tourism is roaring back in some parts of the world and in other places causing new problems in the post-COVID era. Bye for now.